Hello and welcome to another episode of the Ideal Investor Show, where we really trying to bring you interesting guests that can shine a light on all the different aspects of real estate investing so that we can find a better way and quicker path to early retirement and to our time freedom point. So today we have a guest, Jack Krupey, who has actually gone through that same process for himself, and then he built his business. And the point that he actually found out is that at least some, if not most, of our investments also need to be actually illuminated in the direction of what are ways to reduce or lower our tax impact for our investments, and in general, how can we lower taxes while investing in real estate. And so Jack is going to actually tell us about that, and I hope you download the episode and you will really listen to it, because taxes can be a really big impact, and if you do it right, can really on the other hand be a real incentive to lower taxes so you have more cash flow for your investments and reach your time freedom point quicker. Hello and welcome to another episode of the Ideal Investor Show. And today we want to talk a little bit about how can you do multifamily investments in real estate. So it's kind of akin to what we do with our single family residential investing. And to talk about that, we have somebody who has really kind of mastered and perfected this. It's Jack Krupey is actually with us today. And Jack, welcome to the show.
Great to be here. Thanks for having me.
Yeah, absolutely. And how badly did I butcher the last name there? How is it correct?
It's not too bad. Not too bad at all.
Okay, good. So I think our audience would probably want to know, how did you actually get into real estate and running the company that you have developed?
Sure. So, it's been over 20 years at this point. I actually, I graduated college and it was during the dot-com bust. So I had a job, but it wasn't really as exciting, and I didn't really see the path forward that I maybe did in the late 90s. So I went to Vegas shortly after my 21st birthday, and I saw the money and the glitz and the glamour, and I'm like, what I'm doing, this whole computer IT thing is not going to make me millions of dollars, at least at the time I thought. So I bought one of those books at Hudson News, How to Make $1 Million in Real Estate, and flew back and was all excited. And I called my college landlord. He owned about 20 buildings in upstate New York, and was a broker, but also owned a bunch of, apartment buildings. So I called him, and, this is 2002. So within a couple of weeks, I bought a house, no money down, and then bought another house, no money down. And, really just jumped right into that kind of creative real estate. I was almost like an infomercial dream. Until 2008, when everything froze. So, I wanted to move back to New York City. I grew up in New Jersey. Just one of my dreams was always to live in New York. So I ended up going back to New York. And at the time, there were hedge funds buying non-performing mortgages. It was the start of the financial crisis. So there was a fund that needed real estate people. They needed people who had done short sales, bought at the courthouse steps, knew how to value properties, knew how to make decisions. So I ended up moving onto the banking side, just backing into Wall Street, because anyone who knows me knows I'm not a Wall Street guy. And for the next 10 plus years, I was on the distressed loan side, and ended up going on my own, and then partnering with a family office. And then we ended up partnering with a large private equity fund, and we bought $3 billion of non-performing loans, including from Fannie Mae, Freddie Mac, Goldman Sachs. It was a crazy ride, but eventually I'd kind of created myself a job I hated. My life became looking at pivot tables in Excel and yelling at foreclosure attorneys. And I wanted to get back to that. I got into real estate for financial freedom and flexibility. And, I really just created myself a job and a 50% tax rate in New York. So, what I do now is really just focused more on passive income and deals that are large enough that you don't get the calls at 2 a.m. to fix the toilet, 100, 200 unit apartment building. And there's a lot better tax benefits for larger deals through depreciation and cost segregation than, say, owning a single family or two family house. So really just kind of migrated the business into a more tax efficient passive income. In a way, it's almost a wealth management firm that focuses on real estate. Just from the lessons I've learned myself, I've sort of been able to move the business in a way that's better for tax efficient passive income.
Yeah, absolutely. And thank you for taking us a little bit through that journey. I guess you must be one of the few people who actually understand that whole derivatives of derivatives of derivative thing that happened there. Now, I saw on your website that, there is basically something called a fund. Can you describe how that is fitting into the real estate investing business?
Sure. So we actually have two different funds. We have one that's fully diversified, meaning if you invest in my fund, our fund invests in multiple different syndication opportunities. So what I found was a lot of investors, we have two different groups that tend to invest with us. One is just someone who just wants wealth without Wall Street. They want to pull money from Morgan Stanley or Goldman Sachs, and they want access to private real estate deals, but they don't want to do it themselves. That's a key avatar. The other is a lot of retiring landlords, retired or tired landlords who own a bunch of properties. They've done it themselves, and they know it can be a grind, and they want to move more towards a passive investment. And the tax benefits are very, very lucrative for those types of investors because we pass through accelerated depreciation, meaning for every 100,000 invested, in some cases, investors can receive $60,000, $70,000, $80,000 of loss the first year, just on paper through the accelerated depreciation. Our diversified fund, what we do is we have one fund that's invested in by the time the fund is full, it's usually between 10 and 20 different apartment complexes, self-storage facilities, mobile home parks, really all of the, syndicated asset classes. And we want multiple geographies, multiple operating partners. And for the typical investor who maybe is going to pull 100, 200,000, from the stock market and put it into alternative investments, it's a great way to have diversification across multiple syndicated deals. Because if you're just going to pull $100,000 and put it in one apartment complex in Houston or Dallas or Austin, it's a lot of concentration. And, a couple of years ago, there's the deep freeze in Texas. If something goes wrong, you may not have distributions for a while. If there's a hurricane in Florida, you have a problem. Right. If there's, a deep freeze in Texas. Yeah, I think people are probably somewhat fundamentally familiar, for example, if they do something like a 401k and they're being asked at their risk profile, and let's say they claim it is medium, but that typically, at least from what I've read, means, okay, you're going to get your money into mutual funds or managed funds that supposedly have a medium risk, which is a bunch of different stocks bundled together. And I think what you just explained is in a sense the same thing, but it's not stocks bundled together. It's basically real estate in different locations and slightly different types bundled together. Now, for those of people in the audience that are not that familiar with the syndication approach, from a exit perspective, how long do you typically look for the properties that are underlying basically the fund until you exit from the investment? It's a great question. And, in general, the deals we invest in are typically 3 to 7 years. With that said, in 2021, we had a deal that exited in a year and 2 days. It would have sold earlier, but wanted to hold it 1 year at least for the better capital gains treatment. With current interest rates rising, it's probably leans more towards the 5 to 7 than the 1 to 3. I think that's just probably in the best interest of everyone involved now. Is if you have fixed rate debt, you kind of try to wait through the cycle, and you want to exit when hopefully interest rates are on the decline, because even though cap rates are, the interest rate is not part of the cap rate formula. At the same time, when interest rates go up, it does affect the cap rate. It's not a dollar for dollar impact, but it does, move the needle on eventual returns.
Well, and I would assume if you, let's just for easy imagination, say, okay, you had 10 properties of different kinds and sizes and locations in a fund, they would probably not all exit all at the same time. And so if you have the choice to say, okay, well, we could probably sell it for a nice return, but then we would have to replenish it probably with something else at a much higher interest rate. It's probably a balancing act to say, is it better to exit now and know the consequence, or stay and hope for appreciation to continue to occur, and then exit when the replacement is, similarly financeable? From that perspective, is it correct to assume that the fund itself really doesn't need to close?
We were just going to hold until, every deal will close when or sell when it makes sense. We have some deals with 3-year fixed rate debt, 5-year fixed rate debt. And in general, the buildings tend to sell, when the financing dictates it. Unlike residential,
Right.
There's
So if
not many 30-year loans.
Yeah, understood. Now, can people actually use their 401k money into something like this?
Oh, yeah, absolutely. We have a number of investors who use self-directed IRA 401k. I am not a CPA, but I know the solo 401k has, at least from the attorneys that I've spoken with, there's no issues with UBIT in a solo 401.
Yeah, I actually have one, and that's true. I can confirm. I don't have regular one, so I don't know. But for a solo, I can actually confirm. You're right. That's the case.
Yeah, I think on a traditional, there's likely some UBIT issues on multifamily syndications, just because we are using debt. With that said, if you're going to make a 15 to 20% annual return on a deal, and there's a little bit of tax, I mean, so be it. It's
well, that could be. I didn't want to go there really, but when you just said that, my brain immediately said, how is that different to debt that companies have, right? Because if you hold stocks in a fund, which is very common in 401k, there's barely any company that doesn't have some debt. So, but
look, I'm very much a tax nerd. I mean, I moved all the way to, all of our investments are in the southeastern US and the Sun Belt, but personally, I'm doing this from Puerto Rico right now. So I moved all the way to Puerto Rico for tax efficiency, and I'm blocked from the beach. So, it's not all about taxes.
I think it was last year or the year before, Brandon Bouchard is one of the guys that I used to follow for, other stuff, kind of inspiration and motivational stuff. He moved there, and a whole bunch of other people, not being afraid of the hurricanes, I guess. So typically with syndications, there are different kinds, some where you have to be accredited, some where you don't have to be accredited, or some people have and some people don't have to lend their investment minimums. Can you say a little bit about how that works with you?
Yeah. So we are a Reg D 506C. So we are accredited investors only. And, I think with what's happening with the internet and podcasts, the law changed, I believe, in 2012. And, these used to be country club deals, and you used to have pre-existing relationship, and you were allowed up to 35 unaccredited investors. And with the internet and with just the level, I don't shut up about this stuff. I'm an evangelist for, we have an ebook called Wealth Without Wall Street. And, I just think that so many more people should have more money into syndications and alternative investments and less in that traditional financial system of, stocks, bonds, annuities, where I feel the returns are really subpar in general. And there's a lot of corruption, and we're just like a lot of just salespeople that are just selling subpar returns because it's just the system that is there.
No, I'm totally with you. I mean, besides the fact that what I, in support of what you're saying, would add to it is that anytime the government, at least in my observation over many years, comes up with some rules that have nominal values in them, it always sucks the older that rule becomes. Because if you say country club deals, not going to say that $50,000 in 2012 was a huge amount of money, but from a pure buying power perspective, it definitely was. You could get a really nice car for 50 grand at the time, right? Now, when you look at nowadays, $50,000 is not even the price for an average car anymore, but the number has never changed, right? So the same thing like these qualifications. I mean, if you really wanted to make it exclusive, then you would also have to really make some much more significant changes to the income side. On the asset side, same thing. I mean, keeping the number at $1 million, you basically, have one real estate boom and suddenly like 30% of the population is an accredited investor, So
exactly. It's in one way, the lack of updating that has been really good for the general public because, the average family office, if you have $100 million in general, half of your money is probably in real estate and private equity. Yeah. However, that person that's worth 1 to 10 million, I think 80% of them just have money in kind of stocks, bonds, the traditional financial system. So, there's a lot of room.
I assume we would both agree the real solution is not to make a rule that tries to be exclusive, but to say, okay, let's if they would have made alternative, let's imagine in 2012, they would have said, okay, we want to spend money to educate the public to understand financing and investing. at least fundamentally basics. So you and I don't need to teach him constantly what the basics are. Then you wouldn't need that, because people could judge, okay, is it the kind of investment with the risk tolerance that I have to spend 50 grand or 100 grand or 200 grand on it, right? But the only reason that stuff is like that is put in place is because somehow those who are supposedly representing us keep the public dumb, and then they have to make rules to exclude a few people that want to do a little bit bigger deals than the average, So
it's literally, I mean, these rules are from 1929, from the Great Depression and that first stock market, well, not the first stock market crash, but the largest stock market crash. So it was built in to protect the public, but the rules are almost 100 years old, and I don't know when the last time they updated the accredited investor standard, but yeah, it's been a long time. And
well, the only thing that I'm aware of, I think like 2017 or so, they made a slight update to the individual versus family income thing, because, I think they felt that 100,000 was too little for individuals, so they increased it to 200,000, but it didn't really, because now the asset appreciation, in my opinion, has been so much stronger than the income appreciation. So,
it absolutely has.
Yeah. Now, you mentioned earlier already, and I think it's worth talking a little bit more about it, especially in the context of our topic for season 2 being cash flow, how the massive increases we have seen. I always point out to people, and I'm saying it again for our audience, remember we had somewhere between 0 and 0.5 Fed rate, and now we are at 4.5. It's not 4% more, but 8 times as much. Right? That's important to realize. So I'm kind of curious from your business, from what you're doing, what's the impact on the one hand on cash flow, and on the other hand related to the increase in interest rates? And it looks like, at least for this month, or now that we're 1st of March, this month and maybe the next couple of times, we will just see even more increases, what the impacts will be.
Yeah, I mean, there's definitely been some challenges. I mean, fortunately, a lot of the deals that we're in had fixed rate debt. So the buildings we bought with longer term fixed rate debt, they're just plugging along, and rents are up across the board. The thing about multifamily is, you have 1-year leases at most. So with inflation,
supply and demand, right? I mean, the more people you push out of the ability to buy a house because they can't qualify, the more they have to rent. Basically.
Oh, exactly. And I saw a chart recently. I mean, we're about the most unaffordable that single family housing has been in a generation. Yeah. With that said, there are some deals that were bought with bridge financing with variable rates. And, fortunately, the deals we're in generally had interest rate caps. So the rate generally couldn't go up more than 2.5% or 3% at the maximum. So, with that said, we've had deals that, were purchased with a 3% interest rate, SOFR, which is the new LIBOR plus 2.8, and then rates have went up over 3%. So there are deals that have hit their interest rate cap. And I saw a report yesterday where one of the deals, it was a 400 unit complex in Dallas. The original debt payment was, $500,000 a month, and now it's $980,000. Like, rates have basically doubled from, mid threes to mid sixes in a year. And so what that's done is that has hampered the short-term cash flow. The money that would have paid that distribution of, 3, 5, 6% the first year, that money is now going to interest payments. So, it has hurt the cash flow. With that said, the rents are still increasing dramatically. And, most of what we invest in is what I call value add. We're buying that apartment building built in the 70s or 80s, where if you invest $10,000 to put new kitchens, bathrooms, flooring in, you're raising the rent from $1,000 to $1,400. And if you can raise the rent close to $5,000 a year, at a 5% or 6% cap rate, you can generally multiply by 20, depending on if the cap rate's 5 or 6. 20 is a good rule of thumb, 5% cap rate. For every 10,000 invested, you're increasing the value of the building by over 100,000. So what we're seeing is more focus on cash. more focused on growing the net operating income and less on current cash flow, because that's the way you bail yourself out, is by growing the net operating income and then ultimately increasing the value of the building.
Yeah, and that's actually one thing important to realize for our audience. I want to just point this out. Since we at Ideal Wealth Grower, we are working with our clients or tribe members, as we call them, to get into typically single family or duplex, triplex kind of investments, because that is what they're capable of doing with the amount of down payment that they can afford. But there, it's basically the valuation is based on an appraisal which is comparative to the area. Whereas in multifamily, it's basically a valuation based on rent roll. So if, like you said, 100 units and every unit is $1,000, so it's $100,000. If you can get to 1,400, and then the multiplier, well, that's directly increasing the value of the property. And I think one thing, and I want to ask you this because I've always made that as an assumption, because I don't have people with your experience very often. I've always assumed that in these kind of deals, just by the sheer fact that they are in themselves, whether 100 unit, 50 unit, 200 unit, they're just bigger deals. The numbers are bigger, that you end up with more sophisticated people where you don't have to explain, okay, we improved the value by improving the rent roll by 40%. So obviously this is a reasonable price if we want to sell the property. Is that true? Is the community that you're dealing with when it comes to buying and selling sophisticated in that sense that you don't have to convince them?
Yeah, I mean, I think the buyers and sellers especially, I mean, you don't just walk into a 100-unit complex. To get a loan from Fannie Mae or Freddie Mac or HUD, you need to have experience. So in general, you almost have to partner on your first deal or two, because there's a thing called key principal, where Fannie Mae won't lend money if you want to buy a 100-unit building unless someone is signed on the loan that already owns a 100-unit building. So, by nature, the buyers and sellers are a little more sophisticated, and the investors, the passive investors, it really ranges. So we have a lot of what I'd call tired landlords who know that it can be a grind to own, a bunch of single and two family houses, and eventually they want to kind of trade up, but you don't just walk into a 100-unit building. In general, you partner or you invest passively. And that's really what I did. I was investing passively while I lived in New York. And, I'd owned a piece of a bunch of complexes. And then once I got bought out of my old business, I was like, all right, I'm going to invest a lot of my own money anyway. And then I ended up just based on advice from a bunch of actual partners that I'd already invested with. They're like, you should start a fund, because we always, we need people that can, partner with us and raise capital. And you need to raise millions of dollars in 60 days to buy a building.
Yeah. Well, the reason I brought this up, and I'm glad that you kind of confirmed what I had always assumed, is more in the context of, do I have to be afraid that what is being presented as part of the syndication is really realistically coming true? Right now, obviously, if somebody says, okay, I have 100 units and half of them will be renovated with $5,000 or $6,000 per unit, and then the rent will be increased by 40%. If the work isn't done, forget it, right? But assuming that all the things that are being laid out, like here's what we do, here's what we budgeted for, here's what the market rate shows now, if it were renovated, what it would show. So basically, evidence-based pro forma, for lack of a better term, then people can say, okay, well, this is not a bidding game, even though I can imagine sometimes it might end up going in that direction. But as far as what can you reasonably expect, X plus, that is pretty solid and not dependent on, do you find either somebody completely uninformed? And I'm saying this also because I've seen, not so much in the last few years, but there were times when the market was so crazy that people bought single family units for like almost twice as much as they should have ever paid for it. And I said to my wife, they will never make any money, no cash flow ever, because it's just out of complete balance of what the price was and what you can expect for rent.
Yeah, I mean, Axel, I think that's a very valid point. And, I think there is a barrier to entry here. So I think from a professionalism level, Fannie Mae and Freddie Mac, they'll lend on residential properties, but they lend on multifamily as well. Right. And just to get a loan from Fannie Mae to buy a 150 unit apartment building, I mean, this was not 2005, where if you could put fog on a mirror, you get a loan. The commercial side was always more stringent. So, in order to get a loan on a 100 to 200 unit building, I mean, you need to have a certain net worth requirement, a certain liquidity. To borrow 30 million from Fannie Mae, you need 10% of that money liquid, whether it's cash or stocks that you can sell tomorrow. So just by nature, the partners that we work with, it's not like you could just buy a house, no money down, and have a deal. So the deals themselves are vetted. The partners that are the key principals in the deal that are running the deal are vetted. And one of the reasons, and I've had my grind, I bought houses, no money down. I did that traditional real estate, and then I was very active in the non-performing loans. So we had hundreds of foreclosures. We would just all of a sudden, which deal do we have today? Which house are we going to rekey and secure and realize if they were a hoarder or not? So I've done that grind. And when you go into larger deals, it's really, the larger the deal, the less headache, at least what I've seen. It's not impossible to have a headache, but I know I'm not getting that 2 a.m. phone call from a tenant. So as far as stability.
And I mean, this is part in our approach. We're using turnkey providers with certain criteria for fundamentally the same reason that if you could argue with a turnkey provider, okay, if a turnkey provider had like 4 single families, that's not really a turnkey provider, right? Because the management side for 4 units, that anybody could do that. When they're really growing up to be a true turnkey provider, then they have 500 doors or something like that. And why they're growing up, and I'm sure this is true when you go from like smaller multifamily to larger multifamily, everything, the systems, the management, the people, everything that you need becomes more professional and a little bit more sophisticated. But it can also do that because you don't, on 100 units, at least that's what I've heard from friends of mine, it's not that every unit needs something every month, right? So you still have a percentage expense for the management, but that calculates those things in so that you can have more sophisticated customer relationship management systems and phone systems and pay a little, basically literally have employees that do this as a full-time job so you don't get called, right? So those kind of things, there is a benefit in scale from that perspective. Now, looking a little bit forward, I mean, I can see, and this is the argument that we're making from like developing a passive income portfolio of some kind, is to say, okay, you give the money to the Axels or the Jacks or of the world, and they do what they promise to do. But obviously the environment in which we are operating is changing and has been changing quite dramatically since the end of 21. So if you were to look a little bit forward to say, okay, what do you see? I think we both agree already this myth about rent coming down is not going to happen. But what about the rest? I mean, how long do you think we can afford to keep increasing rates with the goal to get to 2% inflation and other things like that? Where do you see like the next 5 years?
Oh man, I mean, my crystal ball is broken today, but I do. Yeah. I listen to a lot of Peter Zeihan. He has a lot of content on YouTube, and he's an economist, and he bakes in the just population, whether it's growth or lack of growth in many of the major countries, and I share a lot of his philosophy, and ultimately I'm still very bullish on the US. We are one of the few countries that has population growth still. Not to get into politics.
They're bringing in 4 million people, willing or unwilling, and a lot of them, but that's only the trigger, and that's maybe the political part. But the other part is a lot of those people have, on the one hand, very traditional family values, but they also, I believe, are not given enough credit to understand the circumstance. And as long as the rules say and the laws say, if you are in this place, in this kind of bordered in, fenced in area, and you bear a child or you start a family, then anybody born here is a citizen. And that citizen can, as soon as of age, adopt you, so to speak, from a citizenship perspective. I think it is very underestimated how conscious a lot of people are of that, for any of the part of the community that isn't coming in legally because an IT company is recruiting them from India or stuff like that. So I think the population growth is not just immigration of whichever kind, but also family values and these circumstances to kind of basically legalize one's circumstance. And so it's pretty rare for a large country like the US to have that.
Yeah.
Kind of like
absolutely. I mean, Japan, he talks a lot about Japan, and actually China is one of the few economists is actually bearish on China because of that one child policy, and because they have such an aging population, and they're just not having enough children. South Korea, the average family is having like 1.2 children, and you need 2.2 children for the population to sustain. So overall, the U.S. is in a great place in the world, and he has a book called Disunited Nations, and essentially it's really the scaling back of globalization. And with that, there's going to be more onshore manufacturing. We're not going to make everything here, but there are certain things that are going to be manufactured either here or potentially in Mexico. So I think the trade between the U.S. and Mexico is going to increase because the actual cost of labor in Mexico isn't that much higher than China when you factor in shipping costs and everything else. So Houston is a big market, and Peter Zeihan has a whole video about Houston. It's the third largest or fifth largest city. There's the port, there's petrochemical, there's manufacturing. I mean, there's a lot of exciting things going on. So that's one of the markets that we're very heavily invested in, and I think there's a lot of upside. And ultimately, I'm bullish on the U.S. and the U.S. economy, and the onshoring is going to be great for workforce housing. And I mean, who knows what happens with AI and different things and interest rates, but
I hear you and I agree. I actually saw on your website that there's, I think your newest deal is a multifamily in Houston as well. I think that's true. I mean, with some of the locations that you mentioned, I think it's hard to generalize because the circumstances are so different. I mean, some people, and I know it sounds a little morbid, have said, if the Japanese weren't so healthy, they would be in much more trouble already. you look at the average age that they get to, right? That's only because they have a relatively healthy living style and nutrition. Otherwise, it's totally common there that people in their 70s still work every day, and not because they really have to by law, but that's just what the economy needs. It's, I think, very different in China. The thing that I'm kind of wondering is and would be interested in your opinion. We see this kind of divergence of the people that are finding ways, whether it's already in high school or college, or maybe after a few iterations until their mid-30s or so, late 30s, early 40s, to really kind of carve a path that gets to an income level and to a standing in society that gives basically access to all the stuff that you and I and 100,000 other things that people can do. But then there seems to me that a growing part of the population that, for whatever reasons, and there's probably an extremely long list of reasons, don't get on that path. And that group seems to get bigger and bigger and bigger. And I wonder, what kind of stresses and what kind of issues we're going to face, because I don't think the government can handle it. But I'm curious what you think. Is there any way to bring this back together, or are we just continuously going to have more and more of this divergence?
I mean, that's such a great question. And ultimately, I mean, who knows in general, but I've had this debate with my wife regularly because, one of my things is, the government's essentially subsidized college and university for the last decade. I mean, when I started Rochester Institute of Technology, a private school in 1997. And it was $17,000 a year. I think Rutgers, which was the state school, was $7,000. Now private universities are like $30,000 to $40,000. So it's really went up 3 to 4x because the government will give you loans, and when you're 18 years old, you can just basically get almost an unlimited line of credit to go to university. I think they should underwrite the loans more based on what you're doing. If you're in STEM, science, technology, if you're going to get out and make $200,000 a year, great, take out as many loans as you want. But if you're going to be an art history major, nothing against art history, but if you want to go to a private school and you have poor parents and you're going to take on $200,000 of debt to make $30,000 a year, it should be underwritten more like a business decision, like an investment. And
absolutely. Although I think, Jack, you haven't heard the news. They're all going to do NFTs.
And you never know. I mean, the thing is,
that was just
that's funny. It's like, with that said, I mean, I was in the IT industry in the late 90s. That's when I was just getting into business. And there were English majors that were now tech professionals. And look, I have an information technology degree, and I'm, really just a full-time real estate investor. So, what you do, what you think you're going to do when you're 18 to 21 is not always what you're eventually going to do. And, people are very adaptive. So, I think there should be a little bit more focus on doing something. If you're going to take out that level of debt, do something that you have the ability in the residential mortgage market after the financial crisis. There's the ability to repay. You can't just go get $1 million loan because you sign your name. The banks have to underwrite you now. So I think that should happen with university too. And if you want to do art history, great. But if you're going to take out $200,000 in debt, have some ability to repay it if you're going to go in that route.
Yeah, good. There's a little bit of a part of, originally coming from Germany. So there's a slightly different system. My answer to that same question goes on the one hand a little further, but I think it also goes in a direction of messaging, right? As long as the media, the public, to some extent, the parents, anybody and everybody is basically making it sound like that the future is with people who have college degrees. I would say take a moment and challenge that thought for just a second, even with STEM. If you, in a friendly way, consider AI going forward 10, 20, 30 years, and anybody who is now considering, coming out of high school soon, everybody says, I need to go to college if I ever want to make something of myself. I'm actually saying the one thing that AI is not going to do is doing the plumbing in a house. Most likely not. Not going to do the electricity, it's not going to do the painting. Yes, you can find robots and stuff that can help with that, but anything that has to do with the really kind of complex stuff, that I see is going to be way further, a whole generation out into the future.
Oh, yeah. And that's already the last 2 generations. I mean, there's a shortage.
What I'm getting at, my thinking is the messaging. If we will ever bring this kind of divergence back to a convergence, I believe the messaging would have to go in the direction of saying, what do we really need as a society? And what of the things that are technically possible already or will most likely be possible in the near future, can we foresee either ourselves with our brains to have to do or some kind of robot AI-based kind of system to do? And I think when you look into that in that way, you would no longer message 80% of the kids coming out of school to try to go to college. You would say, if you look at what's needed, it's those practical things where you need physical mastery, and you don't get that in college anyway, right? And so that's actually what I think is so sad, that we're still messaging, and I think the numbers are in the 80% level, where they at least try to get a bachelor's or an associate's degree, and then oftentimes get woven into going further and it's not just the field, it's also the number of people within a field. When, on the other hand, you cannot find a qualified plumber or electrician or mason or anything, because the messaging has been, well, that's not really something that could be successful. And then when you look, and I'm sure you have these people, they're not just landlords who don't want to do it anymore, but probably people who build a business and say, okay, I have my electrician business, I have 20 people working for me, now I want to do something with my money, right? And so
absolutely.
I think the messaging would have to change if we would ever see an opportunity to bring it together, and not to say just because you do something with your hands, you somehow second grade member of society or something like that.
Yeah, no, that's a great point. And, I completely agree. And there's been a shortage for a long time. And I came from the Nintendo generation, much to my wife's chagrin, I can't fix anything. And, I play a mean Street Fighter 2 or Mortal Kombat, but just doing anything around the house is not my skill set. And you don't need to go to college for that. I don't know that much, as American, I don't know that much about Europe, but I think Germany does a better job of that, at least from the little I know, of like sort of moving people into the trades where.
Exactly. Well, that's why I said, there is a little bit of that German heritage coming in without going too far. But what is typical in Germany is that while you are in what we would call in the US the high school part of education, you get typically twice an opportunity for about like 6 weeks to do what's called a practicum, to go to a company that you choose out of a big catalog of companies that actually are open to these things every year, to invite some students for like a little more than a month to just be there and observe. And yeah, they're not really in production or anything like that, but they can see how a company, let's say like a textile company or a car manufacturer or a chemical company or pharmaceutical, I mean, you pick any, right? So they go twice and typically encouraged to go pretty, the thing that you think you want and are interested in, maybe the first time, and then something completely different that you kind of interested in the second time. And then when they actually get to the end of high school, they are strongly encouraged to ask themselves, do you want to do a knowledge job? Or did any of these things that you did in these practica and other stuff that you learned about it entice you to go into what's called an apprenticeship program? Right? And then you do apprenticeship, typically 2 to 3 years. You can go then to the second level few years later. And the goal there is to literally go to mastery. And the German term is Meister, which basically means master of the craft. And that is not just that you have shown mastery, but you also then get permission to teach others. Right. And so you can obviously then also build a business, but the journey is typically I do apprenticeship in a business where a master is the teacher. I be there for a while and then I make the decision, do I want to stay with this company or do I want to do my own thing? And the need for that, and I think the participation in college in Germany is still like 25% or something like that, and not 80 or plus percent like we have it. I'm not saying this is the holy grail or the solution for everything, but to be either or is probably not good. It should be probably somewhere in the 50-50 range or something like that.
Yeah, absolutely. 100% agree. And, I don't have kids myself, at least that I know of. But, my best friend, his oldest is definitely like, a hustler in a good way. And, we chat about, does he need to go to college? Like, ultimately, like we could probably get him into real estate investing and, kid will be a millionaire by 30, but at the same time, there's a cultural reason to go just purely for, it's almost like in Europe, they do the gap year, but, sometimes university is like a 4-year gap year to, drink beer.
The thing that we don't pay enough attention to, and then I think we end the philosophical part of our conversation today, but the thing that I believe should get much more emphasis is to encourage people to really explore what they're passionate about. Right? I read an article the other day where somebody said, all you need to accomplish in life is to find one thing that you're obsessed about. And then the question is not, what do you work, or how much time do you spend, or whatever. Like sometimes my clients say, well, we sent this email, wasn't it like 1 a.m.? And since I read that article, I said, that's the reason I'm obsessed. So I'm doing it because I want to help. It doesn't matter to me what time of the day it is. Right.
Yeah,
and that's as find your passion and get obsessed about it, then it's not work and you can do it and you have fun and you love it and you smile and you're good with it and stuff. That aspect, I think, if we can somehow find a way to find and help people find that, then, I can see the future to be quite bright. As long as we still, and I oftentimes ask the question, I'm not asking you, but I want to at least make the statement, why is there such a thing called election, right? Which is something that happens in college. Well, the reason is before Gutenberg, nobody had the books. Only the professors had the books. They put the big book on the lectern and they lectured from the lectern to read out of the books for the students to have access to the information. Fast forward 21st century, yes, we not necessarily have a lectern and everybody has access to books, but the process is still the same. And that has to change, I believe.
Yeah, absolutely. I mean, you need to do what you love. And I've experienced this firsthand. I mean, I was, I loved the hustle of buying non-performing loans. And, everyone thought I was a vulture, but in reality, we actually helped a lot of people because we would buy non-performing loans at a discount. So we would basically get a discount from the bank to buy the loans. And often we would modify the loan. So it was a win-win solution. And we helped a lot of people after the financial crisis that just by being more nimble than the big banks were. With that said, I ended up, we merged the private equity fund and a lot of great people, but it was that New York Wall Street grind and I was miserable. I got into this business to have flexibility and passive income. And, I was essentially chained to a desk in New York. Like I would take vacation and get guilted for it, even though I had vacation days, technically, but, nobody took them. And, one of my business partners, love the guy to death, but, almost as a badge of honor, he stated one time that he's like, I don't see my kids during the week, because he was waking up before the sun rose and getting home before the sunset. And it was like a badge of honor that he worked so much that he didn't see his kids. And I wanted more. And, I think the lifestyle, if you do real estate in the right way, then you have that freedom and flexibility, and it's very, very important. And it's really, most of my time now I spend, talking to interesting people, having great conversations, talking to other passive investors, helping do a lot of informal tax advisory. I'm not a CPA, but using accelerated depreciation so you could earn tax deferred income, and then working with other operating partners and sponsors, the guys that are, there are certain people that just want to grind and they want to do the day to day, but they're not as good about telling the story. They're great at executing, but not as good at marketing. So, I found my niche because I'm the middleman for that. And I love it. I spend every day now just having interesting conversations, whether it's an operator or an investor.
Yeah, and I think what is very important and telling in that sense is our audience is listening to us, and I hope they would say this for me. I can definitely say it listening to you that is the case, right? And that is not typically the standard employee that drives an hour to work and then sits in a chair for 9 hours and drives home. That kind of passion and energy normally is not, or most of the time, not there. So as we come to the end of our conversation, I always ask 2 questions at the end. So I'm asking you as well, if you could meet anybody, who would it be and why?
I was thinking about, I read something about the future, so I was thinking more about the future. As far as who, it would be interesting to meet Einstein, actually. Thinking about, it was 100 years ago, just thinking about the amount of growth in technology from the 1920s to now. And, someone that's that smart with 100 years more of innovation, just be curious like what he would make of, or what he would be able to accomplish with the current technology, taking what he knew and what he accomplished then and add in just the new technology to be like, what else could be accomplished with that mind and with the new technology out there. So I think that he'd be somebody interesting to meet and bring into this world.
Yeah. But if you go there and can do that, you have to come back and tell me the reaction when you say, hey, we try to prove and disprove both relativity and all the other stuff that you came up with, and it seems to be true. I would really, because for him it was totally theoretical, and now with all the stuff like you said that we have, I think it's pretty safe to say, yep, speed of light is speed of light. Relativity is actually what you said. Right? How somebody who came up with this as a theoretical thing would react when you come and say, I can tell you it's true.
A close second might be Sigmund Freud, because with all this wokeness and a lot of the BS happening in the world now, I'd be interested to see what Sigmund Freud would think, because the one thing I'll quote from him is he always said, if it's not one thing, it's your mother.
Yeah. With that guy, I would be a little afraid, because I think before you even get to say anything, you're already in psychoanalysis. Just how you walk and how you hold yourself and how you look and stuff. Anyway, so the second question and last question is, if you had a time machine, you can go forward, backward. You know what you know, you just can't change the world or make, like stop a war or stuff like that. Where would you go and why?
Yeah, I mean, similar to the first part, I'd like to go into the future. I mean, I think about, my grandmother who was born in like 1926, just at, literally, airplanes were 10 years old and, they had the first car, and, to go 100 years and see the level of technology. And even, we're both, the last generation that remembers pre-internet. The thought of going 100 years in the future just to see what we accomplish if we don't blow each other up, or or some crazy
absolutely.
disaster.
Well, and many guests have said that. I always kind of respond in, if you go and you were taking me along, I would want to know if that city on Mars actually became reality.
Exactly. Yeah. It's I gotta hope. I mean, I'm an optimist at heart, so I gotta assume. And we mentioned AI a couple times. I mean, every other time. I mean, there was a thing about buggy whips. When the car was first going mass market, it was like, oh, what happens to the people who made whips for the horses for buggies? And people adapt. So I gotta hope that there'll be an adaptation and that there'll be other jobs and people will find another way to be useful and productive.
Yeah, absolutely. And I mean, like I said earlier, I find messaging and naming things is way more important than I would have ever imagined it to be when I was kind of young. Because just imagine for a moment, instead of calling it artificial intelligence, we would call it machine learning, right? Because I believe if we were, and this is actually what it is and what it does, machine learning, I think everybody would say, okay, what are potential great things that could happen when machines can learn stuff? But what are things that we don't want them to learn, right? And by making it some kind of esoteric name associated with it, and it depends on how you look at it, but the potential, I think, can be potentially squelched just because people make it this kind of weird thing that nobody can imagine, right? And we all know what learning is, so I think it would be much nicer if we could find a term that is more relatable. But anyway, I'm not the one who makes the names. All right. So, Jack, thank you so much for being on the show. One last thing, if people say, okay, this is really cool, Houston area, I like the idea of having kind of like a real estate mutual fund is cool, how can they get in touch with you?
So we're on all the major social media, LinkedIn. I have my personal page as well as jcaminvestments.com. That's JKAM, short for JK Asset Management, jcaminvestments.com. And we also have a podcast, and I'd love to have you on sometime. I love this conversation. We just went off very deep. But the podcast is called Alternative Investor Mastermind, where we talk about really everything outside of the traditional stocks and bonds. We've had real estate, a little bit of not much crypto, but a little crypto, mobile home park, self-storage, really all the alternative asset classes. So it was really fun conversation, Axel. I really appreciate it.
Yeah, me too. And we do that next. Sounds very good. So thank you, Jack, and talk soon again.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.